You cannot save yourself to wealth. Investing is a must, but the major question is, which investment account should you set up? Do you need an IRA? Do you need a 401k? Do you need an FSA? All these acronyms can be confusing, and that's why on today's episode, I'm going to teach you the 5 investment accounts every millionaire must have if they want to not just build wealth, but if they want to build tax-free wealth. And make sure you stay for number 3, because I'm going to teach you a strategy how someone turned a $2,000 investment account into $3 billion 100% tax-free. All that plus more on today's episode. What's up, family? Welcome back to another episode of Tax-Free Living. I'm your host, Carter Cofield, licensed CPA and tax strategist. And today, we're not just talking about taxes, we're talking about tax-free investing, because there are certain accounts that you can set up that will allow you to invest, but they will also allow you to invest in tax advantage ways so that you can minimize or completely eliminate your taxes on your investment income. So today we're going to go over all 5, and we're going to start out the gate with one of my favorite accounts, which is number 1 is a Roth IRA. What is a Roth IRA? A Roth IRA is an investment account that you set up today and you contribute money to it. Now, when you contribute money to the Roth IRA, you don't get a tax deduction today, but guess what? That money grows tax-free forever. So you pay taxes today, and as that money grows, you never pay taxes on it in the future. Now, in 2025, you can contribute up to $7,000 into your Roth IRA account. And that amount changes almost every year. Last year, I think it was $6,500. This year is $7,000. So you want to monitor how much you can contribute to your Roth IRA. But what I love about Roth IRAs is that the money grows tax-free forever. Now, here's a secret hack that most people don't understand about Roth IRAs. You can actually use your Roth IRA as an emergency fund, and instead of keeping your emergency fund at a bank earning 0%, maybe 1%, you can put your money in, you can put your emergency fund in your Roth IRA, because you can take that money out anytime you want, tax-free and penalty-free. What do I mean by that? Well, the money that you contribute to your Roth IRA has already been taxed. So the contribution amount you can take out pre-retirement, tax-free and penalty-free. So let me give you an example. Let's say you put $7,000 into a Roth IRA for 10 years. So your contribution was $70,000. Now your Roth IRA might be worth $200,000 10 years later, but guess what? The $70,000 that you contributed, you can take that out whenever you want, because you already paid taxes on that money. So now, knowing this, you can keep most of your money invested, and you can still utilize the money in your Roth IRA in case of an emergency. Now, hear me out. Do I think you should still have an emergency fund? Yes. But instead of having 6 months in an emergency fund, maybe you could just have 2 months and then have the rest of that money in your IRA earning 8, 10, 12% interest annually, allowing you to grow your wealth faster. I absolutely love Roth IRAs. So that's number 1. Now, what is number 2? Number 2 is something called a solo 401k. Now, solo 401ks are only for business owners that have no full-time employees, hence the word solo. So if you're a solopreneur, you can have a solo 401k. If you hire your spouse into your business, you can still have a solo 401k. It's just you can't have any employees outside of your spouse that works full-time. Now, you can have a part-time employee, and you can still have a solo 401k. So there's ways around keeping your solo 401k with minimal team members, but it's mostly for solo entrepreneurs. Now, why do I love solo 401ks? Because in 2025, you can invest over $70,000 into this solo 401k account every single year. And if that solo 401k account is traditional, that means you will get a $70,000 tax deduction for the money that you invest in your solo 401k. So you're going to get a tax deduction today for increasing your net worth tomorrow, which is why I absolutely love solo 401ks. Now, we had a client that recently hired us, and they had never heard of a solo 401k before. This client was making about $500,000 in her business, and net income, she was probably still keeping $350,000. So we set up a solo 401k for her, and we were able to max out her solo 401k at the $70,000 mark. Now, what was key for her is she was concerned. She said, well, if I put this much money in my account, what if I need to use it for something? What if I need to use? What if I need to use it for emergencies? I can't use it until I'm 59 and a half. And we said, well, it depends how we set up your account. So because we knew she was worried about this, we set up her solo 401k with something called a loan provision. What does this mean? This means that she will be able and eligible to take a loan from her solo 401k whenever she wants to, tax-free and penalty-free, because loans to the IRS are not taxable. So now she put this $70,000 in her solo 401k last year, but with the loan provision, she can borrow up to $50,000 or 50% of the investment account, whichever is less. This gives her the peace of mind and the flexibility to still invest and save for retirement, but not have all of her money tied up. So if you're a business owner who wants to invest in retirement accounts, but wants to have flexibility, a solo 401k with a loan provision could be a great account for you. Now, let's move on to number 3. And number 3 is what we call a self-directed Roth IRA, okay? A self-directed Roth IRA. Now, what does this mean? Because we heard about Roth IRAs a little bit earlier in this episode, but what is a self-directed Roth IRA? Well, a self-directed Roth IRA pretty much means what it is named. You can actually self-direct your investment into whatever investment vehicle you want. You see, with traditional IRAs and Roth IRAs, you can only invest in what the investment institution allows you to. So if you open up your Roth IRA at Charles Schwab, you can only invest in stocks because Charles Schwab only allows you to invest in stocks and only get compensated for you investing in stocks, ETFs, and mutual funds, right? But it doesn't mean that you can't invest in other asset classes. It just means that Charles Schwab won't let you do that. So with a self-directed IRA custodian, they say, hey, you can invest in stocks if you want, or you can invest in other asset classes. You can invest in cryptocurrency. You can invest in real estate. You can purchase businesses for all we care, right? They allow you to self-direct your investment in whatever asset class you want to. And what I love about this is because some investors would love to invest, but they want to invest in what they know. So they want to, if they know real estate, they want to invest in real estate. If they understand crypto, they want to invest in crypto. But most of them think that they can't invest in these asset classes with tax advantage retirement accounts. And that is false. That is where the self-directed either IRA or the self-directed Roth IRA comes in. And just to show you all how powerful a self-directed Roth IRA can be, let me tell you a story about this gentleman by the name of Peter Thiel. So Peter Thiel was a avid angel, and he was an avid angel investor, right? He liked investing in other startup businesses. And one day, Peter Thiel came across this amazing opportunity to invest in this startup that you might have heard of called PayPal. And he was one of the early investors into where he was able to get shares for less than a penny a share. So instead of Peter Thiel purchasing his shares in a traditional brokerage account, he decided to set up a self-directed Roth IRA. And he funded his self-directed Roth IRA with $2,000, and he bought thousands of shares of PayPal. He did this in his self-directed Roth IRA because he knew that because it was a self-directed Roth, remember, with Roth IRAs, we don't get a tax deduction today, but the money grows tax-free forever. So when his PayPal shares decided to grow as the company went public, he was able to turn that $2,000 worth of PayPal shares into, get this, into over $3 billion. And not just $3 billion, $3 billion tax-free dollars, because all of that profit was inside of his self-directed Roth IRA, which means none of that money was taxed in the future. This is what the super and ultra wealthy, these are strategies that the super and ultra wealthy take advantage of. And now that you know about it, you can take advantage of it too. So moving on to the next strategy. And this is one of my favorite, guys. HSA, a health savings account. So what is the HSA? An HSA is one of the few accounts that give you a triple tax benefit. Number one, you get a tax deduction when the money comes in. Okay. Number two, the money grows tax-free because the money is invested. And number three, as long as you use this money for health-related expenses, you don't have to pay taxes when the money comes out. So there are very few accounts that you'll ever hear that gets 3 tax benefits on the same dollar. And what I love about HSAs is that not only can you get a triple tax benefit on the same dollar, but if you set up an HSA today, and let's say you set up HSA today and you fund it this year with a max, I think it's $4,150 if you're single, $8,300 if you're married. You can fund this account with the $8,000 if you're married. And let's say you have health-related expenses this year. You could use your HSA to pay for those health-related expenses, but you don't have to. Okay, you can actually leave the money in your HSA, leave it invested, and you can pay the health expenses out of pocket. And then 10, 20 years later, when your HSA is worth $500,000, you can then look at all the health-related expenses that you had over the last 20 years. Let's call it $100,000 worth of health-related expenses. You then can pull that $100,000 from your HSA tax-free and penalty-free and use it for whatever you want, because that money could have been used by your HSA, but instead of depleting your HSA over the years, you let it grow, and then you decided to reimburse yourself for those health-related expenses later and put $100,000 of tax-free money back in your pocket. Crazy, I know, right? And this is why we love HSAs. Now, let's bring us to number 5 and our final account. If you want to be a millionaire, I believe everyone needs to have a traditional brokerage account. Now, with a brokerage account, it is not tax advantaged, right? It's not like an IRA or a Roth IRA. You don't get a tax deduction when the money comes in. The money doesn't grow tax-free. It's a standard investing account, right? But why do I think it's vital for everybody to have this account? Well, with traditional brokerage accounts, you are able to borrow against the value of your portfolio depending on where you invest the money. We love a company called M1 Finance. M1 Finance allows you to borrow against up to 50% of your portfolio. And let me just give you a quick discernment, the difference between borrowing against and borrowing from. If I have $100,000 in my investment account and I borrow from it, I'm going to have $50,000 left in that account. Make sense? But if I have $100,000 in my investment account and I borrow against it, I still have $100,000 in my investment accounts. And now I have $50,000 of loan cash that I can use for other investments. So when you borrow against the value of your portfolio, the money is still invested and you get to also get extra cash. It's essentially double dipping in your investment portfolio. Now, why is this so beneficial? What we teach our clients to do is to take a portion of their brokerage account portfolio, borrow against the value, use that borrowed money to purchase real estate. Now, why would they use this borrowed money to purchase real estate? Because once they purchase real estate, they can take advantage of something called a cost segregation study and depreciation. So we are able to now depreciate a certain percentage of that property. Now, why is depreciation key? Because depreciation is a deduction that you can use against your other investment earnings or against your ordinary income. So if let me give you an example. Let's say we had a $500,000 investment brokerage account, investment portfolio. We can borrow let's call it $150,000 from that account. Now, mind you, we still have $500,000 in our investment account, but now we have $150,000 in borrowed money. We can use this $150,000 in borrowed money to buy a $800,000 property, right? Now with this $800,000 property, if we do a cost seg, we can get a depreciation of 20 to 30% of the value of that property. Let's just call it 25%, right? That means that we get a $200,000 tax deduction that if we strategize properly, we can use that $200,000 write-off against our ordinary income in our business, which will lower our taxable income this year. So we're essentially going to use the same dollar 3 times. We invest the money in our portfolio, we borrow against it, we bought real estate, and then we use that the depreciation for real estate to wipe out our taxable income, giving us more money in our pocket. And these are the strategies, guys, that millionaires and multimillionaires take advantage of, and you should be taking advantage of them too. So if you love these strategies, do me a favor, hit that like button and smash that subscribe button and let somebody else know about today's episode. And last but not least, in the comments below, let me know which of these accounts is your favorite and which one will you be setting up in 2025.